Roy, thanks for sitting down with Livewire today. Spread tightening and carry have been driving a lot of the performance in the Yarra Enhanced Income Fund of late. Can you just briefly explain them, and do you expect those factors to continue?
One of the things that you hear about carry, and essentially it's the income generation off the securities we have in the fund. Today in the Yarra Enhanced Income Fund, our carry or income that we're generating is about 6.25%. If I compare that to sort of 2 years ago, it was sort of 3%. So it's a great space for us to be in at the moment. What does carry do? Well, carry or income actually protects you from things that can go wrong, whether that's credit spreads selling off or changes in interest rates. So that's why people say today it's probably one of the better time to have fixed income in your portfolio, because the amount of income provides defensiveness, and fixed income didn't have its defensiveness 2 years ago. Today it has. Spread tightening, that's been contributing to our fund. It's been about the sectors that we've been exposed to has been contributing. Things like bank and insurance tier 2 has been really solid performers for us. I expect that to continue. Today credit spreads are still trading above average. Corporate balance sheets are in really, really good shape, especially investment grade companies that that primarily we're investing into. And I would think they're not going to have a tremendous rally into the future, but I think they'll slowly grind in.
Roy, new deal flow that's been picking up of late. How does that impact the way that you're investing?
Yeah, the more the merrier from my perspective. Look, first of all, we're about getting paid for risk, but it also, the more deals, and especially if they're new issuers, it gives us the ability to diversify our portfolio. So if we do like a new issue into the marketplace from a credit point of view, and we're getting paid for that risk, then what it does, especially if it's a little bit illiquid and you're getting paid a illiquidity premium for that security, then you can look across your portfolio and say, well, how does this stack up versus something in the portfolio? And you can do this rotational trade. And in some ways, new issuance always gives you that ability to improve the quality of your fund.
Roy, how does equity market volatility impact the flow into fixed income? Are you seeing a lot of investors shunning equities because of the volatility and coming over to the fixed income side?
Look, I think it's about volatility, but also price comparison and return expectations into the future. And I think you've got to be careful what you wish for. In some ways, you don't want too much equity volatility, because that has flow-on impacts into the credit market. I always look back to the pandemic and the amount of equity volatility we saw, that naturally flowed into credit markets. But as it turned out, it was provided one of the best investing opportunities for credit in my career. So I think from our perspective, a nice slow sell-off in equities is fantastic for credit markets. As I mentioned earlier, corporate balance sheets are in great shape, right? So it's really important to think with that context in mind. And if we have good corporate balance sheets and we can generate sort of returns in that sort of 7 to 7.5% return mark, that looks extremely attractive for us, and we can lock that rate in for 5 to 10 years. Now, if you compare that to equities from a valuation or expected return perspective, over the last 10 years, the ASX 200 has generated an average return of 7.1%. So you now would argue that you're getting equity type returns in fixed income today, which puts a smile on my face.
Does it put a smile on the face of all the equities guys here at Yarra as well, Roy?
Probably not.
Fair enough. Just to finish up, Roy, what's unique about the Yarra Enhanced Income Fund?
It's funny you mentioned the equity team. One of the things about the Enhanced Income Fund is, obviously I've been managing it for 21 years now, and we have a pretty experienced team. But it's a good question, because it made me really think about what's unique about us, and it sort of goes back to the Yarra investment team. I think we are pretty unique. We work the fixed income team, or we don't really see ourselves as a fixed income and equity team. We see ourselves as an investment team. We work together, we share research, we talk about companies, we share company and morning meetings together, daily meetings. So to me, I think that's quite unique, because normally fixed income and equity sit opposed to each other. So we've got a really tight-knit group that work for each other, which I think leads to better investment decisions.